Valens Research, Uniform Financial Analytics.
Exxon Mobil is one of the largest oil producers and natural gas producers in the world. For Exxon, you might look and you might say, okay, as reported ROA actually gets this company's profitability pretty right? I mean, as an oil and gas business, it's a pretty boring business. There are some noise in terms of where asset growth is, in terms of misrepresenting the fact that this company didn't really shrink in 2020, like as reported metrics would tell you. It didn't grow as much as you think in 2019. But the really powerful thing for ExxonMobil is when we come down here and look at PE. You might look at ExxonMobil on an as reported basis and you'd say, hey, you know what? Yeah, I understand. It's in a challenged industry, oil and gas, the energy industry is not great, but it's also a world-class business trading at a 16 times multiple. That's actually a pretty decent discount. And if I think that in a global recovery with everything that's happening with oil prices, et cetera, that there's actually going to be potentially a cycle here for oil and gas, and we should be owning the business, this looks like a really interesting company. The only problem is it's not actually trading at a 16 times PE. ExxonMobil is trading at a 31 times PE. The market at current valuations is already pricing in it like it's going to have a good positive cycle. Because at a 31 times multiple, the market's saying, yeah, your earnings are going to grow a lot, go up a lot from here, right? From even 2021, they will. And you can see for a company that basically since 2014 has been around a 4% ROA business, the market is pricing in ROA to get to 4%, which were this last cycle high after we got out of the energy super cycle that we were from 2001 or so to 2013, 2014, after the oil bubble burst and the natural gas bubble burst too. So you can see as the market already is capturing that and capturing that ExxonMobil is going to continue to reinvest in the business, but we would only realize that if we're using the uniform accounting data to realize the company's trading at a 31 times multiple pricing in a cycle, not at a 16 times multiple at the bottom of its cycle, saying that there's an opportunity. This literally changes the context of how we think about analyzing businesses if we're looking at the right data, right? If you rank order ExxonMobil versus all of the US market on PE, on an as reported PE, it might be in the top 20%. It's one of the cheapest companies on an as reported basis. It's only when we look at it on a uniform accounting basis that we realize it's actually probably in the bottom 20% in terms of valuations. And it's a poorly run energy company at this point. Totally changing our conversation.
Valens Research, the world's leading source for uniform financial analytics.